right, so we are in 2018. I'm going to show you a few things that I believe will benefit you greatly as we start the year. Hey, Dijon, Happy New Year. Good to hear from you. Hopefully, everything is well with you. Before we begin, I would like to just make sure everyone understands the risks of trading, a disclosure, just to make sure everyone is clear on how the market can benefit you as well as you could lose money when trading. So please be careful. Obviously, we can't trade with funds we can't afford to lose. So please talk to your broker. Please understand the risks with trading. It's not for everyone. It's volatile and sometimes it's slow as well, but you have to understand that there is no guaranteed success in trading. Before we begin, has anyone here watched the video on the January effect? And the January effect is something I do every year just to educate the traders to make sure they are clear on how the market at the beginning of every year can typically dictate the future as the professional traders look at the first month, January. And they look at it as a tool to help understand whether or not the year will go higher. So what this is all about, and I have plenty of videos dating back to 2008, 9, 10, 11, probably going back 10 years, where I try to do this every year, and I do a couple of updates throughout the year as well. And so the way this works is we're looking at the first month, January 2018, or January 2019, or January 2020. In January will either be a higher close than open, it'll be higher from where it began, or it won't. So as simple as you can make it, where does the market open at the beginning of January, Tuesday, yesterday, and where will it close on January 31st? So we have here a price that we're going to use, which is 2675. Okay, so we'll use 2675 right here. This is where the market opened. This is the S&P 500, the E-mini. You can do the same thing on the Dow, the Nasdaq, the Russell. You may even be able to do it on different markets. I haven't tested it, but I do know this is how they look at the financials, the US financials primarily. But it could be that it could work in other markets. I don't know. So 2675 is where the market opened yesterday. At the end of January here, where will the market be? Will the market be higher or lower from 2675? If the market is lower, the year could go up, it could go down, the market could be flat. I don't know. There's really no relationship between whether or not January closes lower than where it opens. But if the closing of the month of January is higher, even by a couple of points, that sets off this idea, which is, I would say, close to 90% accurate. If you take all the years going back to when the stock market began into the S&P 500, now into electronic trading, if you held on to that position, the market will be at a higher price come December. Now, we can test this. It's very easy. And like I said, it's about 90% accurate. And when February 1st rolls around, just make sure that the market has a higher price than where it opened. Very simple. It's not rocket science. Sometimes traders make this more complicated than what it has to be. So just remember, look at February 1st. Where are you? If it's higher than 2675, great. Think about being a buyer on pullbacks, buying the market, looking at, for example, the Atlas line for the day every time there's a bullish opportunity, or even scalping. So whatever you want to do, think about the year just pushing higher and higher. But obviously, as a trader, we can't just buy and hold, especially a day trader, especially with the futures market, because if the market goes down 100 points before it goes up, that's not something we're able to do. So I have a different plan of action, a different course on how to trade throughout the year when the market gives us this opportunity as a buyer. So the first thing with this January effect is, will January close higher than open? It has to close higher than 26.75. So any questions before I continue? Make sure everyone is clear on the first part. Higher close than open. So 26.75 is the determining price that we're going to use to tell us whether this is going to occur. Now, if I go back to, just as an example, January 2017. So when I go back to January 2017, you can see that January opened and closed here. So I think everyone would agree that the closing price at the end of January was higher, January 2017, than where it opened. This being 22.35, this being it opened here at 22.75 or closed here at 22.84. Nonetheless, this is up. Now, what we do with this information is buying opportunities on every pullback or every breakout. So I'm going to say again, every pullback that happens or every breakout. We can't hold on to a long position because the market could reverse and go down for a month or two before it turns around and goes up. So I want to be a buyer. I know that the market will most likely close higher in December. So what I'm going to do is I'm going to look for the first and the best opportunity, which is to see the market go down and retrace a minimum of 3 to 4 days, a good, healthy pullback. It doesn't matter if it's based off of news. It doesn't matter if it's based off of a tweet, for example. It doesn't matter. It's irrelevant. I want to see a few days where the market retraces. Now, this here is not really considered a retracement, right? I look at this and I don't really see a good, healthy 3 or 4 days that the market went down and down. So this doesn't really help me. What I do see, though, as we go forward here, is I see all of this as a retracement. Now, this may start off an idea that the market's now going to go down and down and down. That may be true. But if it does turn around and come back up, this is where I want to be, as the opportunity to head back up is showing me and proving to me that going long for the year under these situations will help you, because January was higher than where it opened. How do you get into this type of a trade? Well, what I want to do after I see this healthy pullback is I want to see the market begin to turn around and go back up to test the highs. This idea that markets love to test the highs or where the market has previously been is something I talk about and I teach constantly. Always remember, markets love to be and to trade in areas where they have already been. If you're trading into a new high or an unknown price or a new low, that's unknown. Where will the market end? Where will the market stop? Where will the market reverse? All those things I really don't know. But I do know the markets like to trade and be in areas where they've been. Therefore, I'm going to use a drawing tool, which every charting platform has. Every charting platform has this Fibonacci retracement tool. Now, I don't use Fibonacci's in anything that I teach. I'm only using this tool to help me identify the 50% mark. Hey, Happy New Year, Stan. Hey, Kamaljet. I only use this tool to identify the 50% retracement when it begins to turn around. This 50% retracement is enough for me to say that after we have the market pulling back and now it's turning around and testing the highs of where the market has already been, this is my opportunity to buy it as it breaks the 50% heading back up to test the highs. If it's not a January effect year, which means if January is not higher than where it opened, I can't use this method. This only works when we have, or I should say, it only works when we know that there's a January effect for the year in place. I'm sure it could work if it's not a January effect as well, but like I said, 90% accuracy is pretty good if you follow it. So I don't want to just have a long at the closing of the day when it hits the 50% marker. I want to see a stop or a stopward limit breaking, meaning penetrating through. So I'm going with the momentum as it breaks through. So in reality, if you're going long here or you're going long here, it's a long. It's as simple as you can make it, it's a long. Even if I take it back to, and I'm going to show you that this is not picking and choosing certain areas on the chart. This is looking at very simple rules, 3 or 4 day retracement, which is here. That's 3 or 4 days, right? And now I can see the market break the 50% and go up. It's the same thing. So I want to buy, I want to be a buyer when that happens a few points above the midpoint. Now, what can you use to get you in besides a stop or stopward limit? That's just an order. But if you have something else in your toolbox, whatever it happens to be, I'm going to mention the Atlas line because that's something that I offer. If you have the Atlas line as a tool, the Atlas line gives you long and short above or below the Atlas line. I'll show you the Atlas line for yesterday and today in a little bit. But we can go long if the day is breaking the 50% marker, which it is, and it's above the Atlas line. Now you have two things in your favor. You have the market retracing up to test the highs. You have the market now with a smaller tool on the 5-minute chart or 15-minute chart. The Atlas line works in 5 or 15-minute charts. So with a 5-minute chart, if you add the Atlas line, it's above. At the same time, it's breaking the midpoint by a few points. Now you have the opportunity to buy it. Now, if you don't have the Atlas line and you just want to buy the market a few points above, in this case, looking at about 23.71 or 72, right there. When it breaks above that, if you want to go long, that's fine. But use something else. I think it's important to use something in addition. As you know, I have some mentorship students here in the class, like Dijon. I like to combine things. I think you have the power behind you when more of the methods that you're using are confirming as opposed to everything being conflicting, where everything is all over the place, where something is telling you long, something is telling you short. I much rather go long with this and with something else in addition. So for the day, as a day trader, look at an opportunity to buy it if everything is telling you long and it's breaking above the midpoint. What about a target? Well, I do like the target being the highs previously made. That's a really good target. But sometimes, as you can see, it didn't make the target, didn't reach the target. So what else can we use as a target, at least to start us off with a trailing stop, or at least to start us off with a few points? What can we use to really, as an objective model, take a profit? Instead of just saying, I'm going to go for a point, I'm going to go for 2 points, I'm going to wing it. I like to look at the current conditions that the market is telling me and showing me. That happens to be the ATR, the average true range. And I have Chad in the room here as well answering questions. Anyone has any questions, he'll be able to answer your questions. And what's going to happen here is a target based on the current conditions will never steer you in the wrong direction. It is an objective way to know the expectation of the move. Can I expect a point, 4 points, 10 points? I can expect about 16 points based off the ATR. You have to have a stop, and I'll go over the stops in just a minute. So give me just a moment, I'll cover that. So I can expect the market to move at least 16 points. And if it doesn't, I have a stop to protect me. Please always trade with stops. Don't trade without them. And 16 points from here to here is a price of 23.70. 88. It's not even reaching the highs. I expect the market to reach the highs and to test where it's been, but that would be my initial target before the trailing stop kicks in. And if you haven't seen the trailing stop, maybe Chad can put the link in the room to the blog post on trailing stops. I think it's a great video that everyone could watch, where I teach that in previous webinars. So now the market starts to move, and you see that it went just in front here of the 16 points. This is the target that I expect, or the move that I expected the market to make. Now, as we go further down, if you continue to adjust this, this becomes a new opportunity. If the market turns around and goes back above the midpoint after making a new low in order to test the highs, you do have another opportunity using the same rules. And the same is true if it just continues to go down. So you see this would be the entry, never happened. Here is the entry, whether it be on this candle or this candle. And you look at the ATR at the moment, whether it's 10 points, 15 points, 20 points, it's really the same idea. You're just looking for the market to test the highs when it provides a break of the midpoint by a point or two. Now the stops. Somebody asked about the stops. The stops on this, I like to use what's called a pivotal stop. This is something that I use with the Atlas line. I use it with the X5 trades. I use it with the roadmap trades. The pivotal stop is basically looking at a pivot and looking at the market reaching a certain price and then pivoting and turning around and thinking of this lowest low as a pivot, or thinking of this lowest low before it turned around and gave you the long position as the pivot, and adding a little bit of a buffer. Usually I like 2 ticks for a pivotal stop as a day trade. With a daily chart like this, I would say maybe a point, because markets love to test where they've been. So I don't think it really makes sense to place the stop at exactly the lowest low or highest high for whatever trade you're doing, whether it's a day trade or this or an intraday trade, because the market will be very easily able to test that. And if it tests it and it stops you out, that doesn't help you. So a little bit of a buffer, I would say a point or two, just under the pivot, a pivotal stop. I use 2 ticks for a 5-minute chart when it comes to string trades and pullback trades and X5 trades and things like that. So we have a little bit of a buffer during the day. We have about a point or two as a swing trade. That way, if the market comes down and tests it, I'm not knocked out unnecessarily. As price action, this is universal. I would not just say this is for the even the S&P or for the Dow or for the NASDAQ or for the Russell. I would say this is for any market that you trade, even the new Bitcoin contract. Pivotal stops are very important. Add a little bit of a buffer, 2 ticks or so. Now, if the market turns around and breaks the high, which it did here, to get you into the market, like I said, the stop is here. I'm not sure if everyone in the room is able to withstand all of this. I know that it would be very difficult. So I can't say to everyone here, hold on to this trade and use the pivotal stop. If the market starts to go down and it's not in your favor, you're not trailing a stop, I would not risk more than 1 or 1.5 times the ATR as a position trade. We want to see the market immediately go up to test the highs. So this, I think, realistically would be very difficult to hold on to, because this is 20 or 30 or 40 points. If you're using 1 times the ATR, 1.5 times, it's more than enough to see the market make the move. But finally, you can see here that it broke it. So when you enter long, and you also realize the Atlas line is giving you long, one of those days that just starts off strong and just keeps on going and going, this is a great opportunity. Again, if you look at the ATR, even if you want to be a little bit more conservative, this is about 21 points. You say 20, you say 18. I think you were able to achieve that here. And then you can trail a stop, but really the ultimate goal, I have to admit, would be to test the highs. This is ultimately what I really do expect the market to reach. We may have to go through a little bit of whipsaw to get there, or a little bit longer. Sometimes it's immediately, but really looking at 1 times the ATR will benefit you greatly, because then you have nothing to lose. If the market doesn't reach it and you're trailing a stop and you get out of the market, if it never makes that test, you're safe, right? You don't have anything to lose. I don't consider this really that much of a retracement or a pullback, something I can sink my teeth into. But even if you went and just used this here in a smaller scale, 4 days, 3 days, something really significant that you can say it's a retracement, as soon as it turns around and comes back up to test the highs, the ATR is slow, like a cycle. Market gets volatile, market gets slow. Market gets volatile, market gets slow. So 12 points would be something I could expect. So from here to here, the market went about 10. So we're not that far away from an expectation. Now from the market doing this here, it's 3 days of the market really coming back. I'm not sure if that in a live environment would really tell me. I mean, I can see that it did go and retrace in a strong manner, but it's really just 1 day of a strong retracement. That being said, the same applies. It breaks by a point or two, you're long. Maybe we can expect 20 points out of the trade based off the ATR. And I have to say, I'm going to add here the charts just to show you the Atlas line it's about to fire off. And so I do want to show you that live. And so what I'm explaining to you here is an opportunity for 2018 to take advantage of the market every time it retraces, that it will provide you these great opportunities if you know how to find them and you know how to look for them. So I am going to show you a few more examples. I just want to make sure I have this up so I can show you live trades, live examples of the tools for day trading. Atlas line, I have the at the open as well. Okay, so now let me continue here. Once again, this, I think everyone would agree, does not really constitute a nice, clear retracement. Okay, so we have a long 2702.75 and a long 2702 quarter. So the ATO and the Atlas line, the at the open 2 software and the Atlas line, they're all telling you long right here. The ATR is about 7 ticks, so 7 tick target, 14 tick catastrophic stop. Okay, so this is a long 2702.75 based on the software. Now, as the market continues here, this, like I said, is not really a clear retracement. I'm not going to call that anything that I can sink my teeth into. And now the market's kind of going flat, but now this happens. All this happens, which allows me to then look at an opportunity to buy it. Where am I going to buy this market? How is this going to work? Well, if I look at the low and I add this here, once the market breaks, I'm long. The pivotal stop, a point or two just under, is here. You have a day that is very difficult to stick with. This is, I think, for any trader here in the room with some experience, I know that this is bad news. But the stops are there for a reason. They're there to help you and get out of the trade based on something, not just because it feels right or feels wrong. Just use the method and the rules. And I have to say one more thing about this. When you see large candles, this is now a different idea on price action. When you see large candles or large days, whether it's a day trading platform, 60-minute, 5-minute, 30-minute, even 1 minute, or as you can see, 24-hour daily charts, when you see a large candle, this tells me that either we're at the last tipping point of an exhaustion and the market may reverse, or the following day the market could give and retrace everything that it made. So it's very common, price action wise, any market, this is universal stocks, ETFs, Forex, it doesn't matter what it is. When you see a large candle, don't expect immediately as 100% opportunity this is going to occur. Instead, I want you to think opposite what everybody else thinks. This is not a moving average, or this is not following an MACD or stochastics or momentum or Keltner or Bollinger or all the stuff that we all look at trying to figure out what values are best. This is basically saying we have a large candle that is a strong trend for the day. The next day could come all the way back. And it comes back to what I said earlier, where I said markets love to test where they've been. So when you see large candles, don't expect it to be a follow-up for the following day. Expect maybe a trend, expect maybe another strong day, but take direction out of that equation. The direction could be up or it could be down. Let me see, Howard has a question here, or David. How come the left-hand chart is showing a price, whereas the right-hand chart is 24? Because this is a daily chart. I'm going over the January effect. David, I'm going over the January effect, explaining what to look for, 2018, the method, how to use it, the rules, teaching you something you could use every single year, not just 2018. And this is a daily chart. This is a 5-minute chart. The 5-minute chart is, as a day trader, I have the Atlas line and I have the at the open there as well. So this is the day trading tools that I offer, Atlas line and at the open. On the chart, this is swing trading for the year. So like I said, the large candles that occur are out of place. The next day could very easily give it all back. You could say it's profit taking. You could say it's a trend that goes down, the trend that goes up, back to back. Whatever you want to call it, don't assume that the market will continue in the same direction after a larger than normal candle. And I'm not even, picking and choosing any specific period of time. I'm just looking at this as a candle much larger than this one, and it's full body green. The following day, the opposite happened. The same thing, a full body trend day, that is sell. The next day it's long, the next day it's sell. How many people do you think sold, assuming the moving averages and all that regular conventional indicators indicated that this would be a selling opportunity, maybe below the moving averages, maybe crossing moving averages, and instead the following day went up? And how many people you think after this happened bought it thinking, okay, I'm going to reverse, I'm going to click that reverse button, and then sold it? So I'm just giving you this idea of don't automatically believe that these large candles are continuations the next day or the next hour or the next 5 minutes. I don't expect, if you take a look at this here, I don't expect after seeing a candle like this, another large green candle. Do you see what happened? Profit taking, market taking a breath, trying to catch up, trying to understand what just occurred. Sure, the market continued higher, but it's not the very next candle. So that's what I'm trying to avoid. Buying as the last guy here, where everyone now is taking a profit. This is all unknown, so I can't say that I know this is going to happen. I just realized this, expecting this. So be careful. And the same thing is true again here. So it happens all the time. It's not something that is unique. It's something that is actually very common. As a price action trader, this is what I look at. Now, I was referring to the market doing this, right? So if you're long here, the market never hit the stop. If you're long here or here or here, the market never hit the pivotal stop to 2 points under the pivot. And like I said, the goal is to at least look at 1 times the ATR. Maybe if you're a little bit more conservative by a few points, it will always benefit you, so you know that you can at least make something and then begin to trail a stop. We're looking at about 15 16 points, right? The ATR is about 17, and the market hit the highs. Now it continued. So let's talk a little bit about how we can take advantage of the breakout when it breaks the highs. When the market breaks the highs, especially when you have a January effect in play, the market breaks the highs and usually continues. I don't want to enter at the end of the day. I want to enter with a stop or stop with limit at a price, at a specific price. So another way that you could trade the January effect throughout 2018 and beyond would be not just the retracement aspect, which I really think is the best way to go about it, but also looking at placing a stop or a stop with a limit, a point or two just above the highs. Now, there's a reason why I'm doing this. The reason why I'm doing this is actually psychological. If you think about traders who take profit or who have stops, where do they usually have stops and where they usually take profit? They usually they have stops or profits at highs if they're wrong or lows if they're wrong, because that would signify that the market is reaching an area where they don't want it to go. It's going in the opposite direction. So if we have a lot of sellers here, selling and selling, thinking the market's going to go lower, they're probably going to put their stops here. When they place their stops, it initiates a buy. What a lot of traders also do is then reverse, and then it initiates more buys. So the reason why I'm acting on a long breakout is I'm counting on the stops, the short traders that need to cover by buying, initiating a buy to get out of their losing position, initiating another buy to reverse and to try to recover. And when they do that, it accelerates the market as a pop. Everybody with me? So when I look at buying the breakout on this, breaking the highs or breaking the lows, think about stops being triggered. The buyers are now reversing, the sellers are now reversing, and they're buying more. It creates the pop. So I'm looking at being a buyer each and every time the market breaks the highs by a point or two. Enter during the day or overnight, whatever, however you want to do it. But you're long, and looking at the ATR here, it's only about 16 points, so be a little bit conservative. See, even 12-point target. 12 points, I'll take that any day. So 12 points from here to here, no problem. Now, as we go forward, and I have to say this, what you're seeing here, just for me to be more specific, let me clarify. This is not every breakout that you go long. This is after this does this, and it's coming back. So what you're seeing here is not something that I would do, for example, here. I would not buy here thinking the same example. It's a different and completely other situation that's happening. I'm only buying here because the market is hitting stops and they're reversing after all this has happened. So you're long, you're out, or you're trailing a stop, you're long again. But you're not long in that same idea here. Please let me know if anyone has any questions on this so far. Larry, Lawrence, Mark, Milton, Nathan, and Jay, Tony, Dejan. Let me know if you have any questions. Debbie. All right. Now, as we continue here forward in time, again, like I said, it's not as if I want to be a buyer here. I want to see the market do this. I want to buy it when it breaks the midpoint, and then I may buy it again when it breaks the highs there. Now, I would say this, if you want to look at a losing trade, instead of me just showing winners and winners, I want to show you that if you were long from here to here, if you consider this a retracement and you're long, great. If you're long when it broke here, this may be a problem. If this happens right here and the market doesn't continue, it starts to reverse on you, you get out of the trade. No problem, Nathan. If I can answer it here, you can send it to me and I can show you. I'll be happy to answer it here as well. So when I look at this, I see this as a great opportunity. Remember, consider it a nice, clear retracement, a pullback, and you see what happened. From here, oops, let me put this back here, to here. Once again, once it breaks the midpoint, even if I consider being a buyer here, which is nothing wrong with that, a little bit of pain or you get out of the trade, but once it's ready to go, it really moves. Now, this is 19 points, so we'll say being conservative, 18, 17. The ATR is indicating 19 points, so like I said, conservative is always the way to go, 18, 17, just to make sure that it actually gets through your target, not just touching it and bouncing off of it. So within the first day, it made the target. Now I'm going to go into a little bit more detail about the targets. The trades that I find to be the best are the ones that immediately go into your direction. So when you look at all of these trades that I've just shown you, yes, they all, for the most part, were winners. But sometimes it took a little bit longer to get there, and that pain sometimes is very difficult as a trader to withstand, right? We don't want to be wrong. So if you're thinking about how do I really know this is going to work, or how can I psychologically handle this, when the market makes an immediate move in your favor, it's euphoric. And this is what I want to see, an immediate break and continuation. When this happens, there's a lot of pain involved with this type of a trade. Your stop may be here, and you may be looking at a potential loss, but if you have your stop and it isn't hit your stop, you're still in it. So if you are in one of these swing trades and within the next day or two, maybe even 3, if your target has not been hit, or if you don't see an immediate position pushing in your favor, you may want to get out, whether it's a break even or small loss or small win, and look for the next time it breaks. Because if you get out of your trade here at a small loss here, if you're unable to withstand this entire downward move, let's say, before it turned around, if you get out after 2 or 3 days, it hurts, but it's not killing you. You can then take it long. So what we really want to see is an immediate reaction and move in your favor. And as I go forward here, this is the highs. Again, if I look at breaking by 2 points, I'm long. 12 points is the ATR, so we'll say 10, right, just to be conservative. 10 points, 14, 17. But I think realistically, we're looking at, 12. I think 12 points. That's the ATR. Is 15, we'll say 12. Just a few points more conservative in comparison to the ATR. No, Nathan, the combination of the ATO and the Atlas line, I think, is a great opportunity for this long here. Overbought, oversold, I would say the Atlas line being overbought because this is a little bit of a distance away from the price in comparison to the Atlas line. If you remember the overbought and oversold criteria, but the combination of the ATO and Atlas line, whether it's the ATO that got you in first or the Atlas line that got you in first, the long here is very similar. It's 27.02 quarter, within 2 ticks, 75. So really it's whichever entry gets you in first, but the combination of both being long is a good thing, to answer your question. So the ATO was not overbought. It's the Atlas line that's further away that creates, I think, a riskier trade, right? We want to enter as close as possible to the Atlas line. And but like I said, I always say don't pick and choose your trades. Go whatever happens first. You have two longs, which is going to give me the long opportunity first. The ATO here gives me a long trade if the Atlas line, if you're not comfortable with it. The ATR is 7 ticks, I think I remember saying. Yep. So from here to here, the market went 10 ticks. So you should be out, right, Nathan? You should be in, you should be out, right? We're not taking a profit more than 1 times the ATR. And this may be a pullback trade now starting again, Nathan. Could be, right? Atlas line pullback. So it's still developing, so we may see that. All right, so let me put this back here. So as far as 2018, look for the retracement, look for the market coming back, look for the pop. Don't believe large candles automatically equal a continuation. They may, but don't just assume that's going to happen. Okay. And now this here, very small retracement. If you want to consider that, I know it worked. If you don't consider this anything of significance, no worries. We have more opportunities. And then there's this big run up, right? So if you're long, as soon as it breaks by a point or two, that's another opportunity. This doesn't count. I don't think that's anything. This as well, I mean, it's okay and you could use it and it worked, but you really want to look at something a little bit with more teeth like that. That looks very good. And now you're long, testing the highs. And you're long again if you want, or if you're trailing a stop. And it continued higher. 3 or 4 days retracement. Here we have it. You're long, a point or two above, you're out, or 1 times the ATR, and so on and so on. Very simple. It's objective. It's clear. It's not complicated with any indicators that are cluttering up your chart. But really, here we are, 2018, and the same examples that I've just shown you, if we have January closing higher, you should be able to take some great moves through 2018 and through 2019 and so on and so on. No problem, say it. Will do. Questions for me? What about some scalping, right? I know you guys are asking about some scalpings. Let me go here to a 1-minute chart. I haven't looked at the trade scalper today, but I'll show you the trades on it. And let me remove here what I drew so it doesn't conflict. I'll add the software and you can see any opportunities that happen. I haven't seen the trade scalper today at all, so I can show you, I can tell you that this is with fresh eyes. All right, so we have a few long positions and nothing so far. Maybe we'll get something here momentarily. And if I look at yesterday during the day, this is what we had yesterday. There are rules, there's training, there's a course, there's software, there's a bonus, the X5 that comes with the trade scalper. But I just want to show you, for those of you who are asking, what about the trade scalper and the signals? This is what we had yesterday here. And this is what we have today. Sure, what video would that be? Kenya. Okay, Chad, you got it. Okay, sounds good. And let me show you one other thing here. Yesterday, I received a lot of emails. First day of the trading year, the market was slow last week. The emails were on what did the market do with the Atlas line and the ATO. Traders that are interested in joining the mentorship January 9th have questions whether or not the method is still working. So let me show you yesterday. If you're curious, first day of the year, how did it pan out? And yesterday we had an Atlas line long, and for Nathan, if you look at the entry, 2684.75, nice and close to the Atlas line. I think this is a better opportunity. It's nice. It's according to the rules, this would be a good opportunity. And you also had a long here on the at the open, which is the software that you're seeing here. It's the ATO, and then the follow-up chase the trade, and you have the pullback and the strength trades. And then we have here in the middle of the day some flop, some chop. So how do we handle this chop? When the market is slow and it's chopping and flopping around, we have to know that trading is not going to be at its best. How do I know that? Look at the ATR on a 5-minute chart. 4 ticks or 1 point is the cutoff. If you start seeing signals and opportunities when the market is too slow to trade, it's risky. And I would say at the same example, when the market's too volatile, it's also very risky because the market's in a chaotic situation. But if the market is too slow to trade, what you have is more chop and dojis and candles that are gapping, a lot of channel flip-flop type of environment. It's very difficult to trade. So these two signals here to go short on the Atlas line, in my opinion, would be skipped because the market is trading below 1 point or below 4 ticks, which is the result. The environment is not really an environment you should be trading in. And that's for any market. It's not just for the even the S&P. Any market that you're trading, 5-minute chart, stick on the ATR setting of 4, and avoid placing trades when the market is slow. Sure, the NQ? Be happy to. So for the scalper, we have a question here for the NQ, JDL. Pull up the NQ and you can see what happened here. For JDL. So this would be NASDAQ at the moment. Well, Stan, the ATR, the average true rate range, is dependent on the value. So I'm using a value of 4 here for any market as well as any time frame. But the values here, for example, for scalping, you can't use 1 point for scalping. I use the minimum of 2 ticks because this is a 1-minute chart. If you go to a 5-minute chart, the minimum would be a point. So it really depends, Stan, on your time frame, what is considered slow or too slow to trade for your time frame. So if you had a daily chart and for the day the market only went, and I can show you here just as an example on a daily chart, if you crunch up here the chart here a little bit and you look at where the market was really at the lowest, well, this is a 5-minute chart, but the lowest point immediately, let me just remove this stuff here. Immediately, you could look at when should I avoid the trade. So you should avoid the trade when you see here this lowest point here being about 7 points. This is really slow for the day. Maybe it was even due to half days or holidays. But when the market on a daily chart falls below, in my opinion, 10 points, so the market for the day can't make a range of 10 points, I think it's too slow. You probably have more chop than anything. And so if I expand this out and I look at each example of when the market hit this slower time period, like a cycle, markets get fast, market gets slow, you can see the result is this. And then it accelerated. The volatility accelerated, so the range got higher, the ATR got higher, but you see how it's chopping around. So it's a relative situation where on a 5-minute chart, stay away from the market when it drops below 4 ticks. On a daily chart, here on the S&P E-mini, I would say 10 points. On other markets and other time frames, you have to gauge it a little bit. So these are extremes when the market are slow, too slow to trade, and There's a lot of gaps in dojis, which will definitely hurt you. Again, whenever the market is slow, you have chop. When the market is volatile, typically it trends. So when you see strong volatility, it won't chop around that easily. It'll go and continue. It's just a price action um, model. So if you see this and I come down and I see this here, it's the same example. The market is cyclically at its slowest, and the result is flip-flop or channel or chop. Stan, let me know if you have any questions on that. And you can always email me as well. So January 9th, we start a new mentorship class. It includes all the courses, Roadmap, At the Open 2, Atlas Line, all with lifetime licenses. And take advantage of the lifetime licenses, because with the lifetime licenses, traders that have been with me since NinjaTrader 6, 6.5, 7, and now 8 have updated their software and created and continued support from me. So I think that's a benefit. Those of you who are in the room that are mentorship students, if you'd like to mention a few words, please feel free. It's January 9th, we start a new class. And we also provide the simulator so you can practice. You don't have to pay for the simulator or pay for data while you're practicing. There's no charge for you to learn the methods. Everything is recorded for you as well. So that's also a benefit where you can get all the details. You have access to the member video account. You got it, everyone. Have a happy new year. And I will speak with everyone soon. Email me if you have any questions. Take care, everyone. Bye bye now. Thank you.